Euro to US dollar just kissed 1.1600 and snapped back 40 pips. The retail crowd is already calling the bottom. But I'm seeing a dangerous structure here, a trap that is about to spring and punish anyone who chases this bounce without a plan. If you're holding a long right now, or you're tempted to buy, stop and listen. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end because I'm giving out 3 exact entry and exit levels you can use immediately. This is not an academic breakdown. This is your trade plan for the next 24 hours. Let's give you the instant market verdict right now. Bias for today's European and US sessions. Fading the bounce. The trend on the daily is a strong sell, and the 5-hour momentum is still a strong sell. That means we don't buy strength. We look for exhaustion in any rally to reload short positions. The one number that proves this bias wrong is 1.1636. Write this down. A 60-minute candle close above 1.1636 would start to shift the whole structure. If we break and hold above that, the bearish momentum is compromised, and we have to respect a larger correction. But until then, sellers remain in control, and every push higher is a gift. Now let's get into the technical deep dive so you see exactly what I'm seeing. We start from the top, the weekly chart. The weekly trend is bearish. Euro to US dollar has been carving lower highs since the 1.2250 rejection 3 months ago. The moving averages confirm it. The 20-week moving average sits around 1.1850, sloping down. The 60-week moving average is at 1.2020, and price has not even sniffed that since the initial breakdown. The 200-week is flat down near 1.1450. That's your long-term magnet. On the weekly, we are in a clean series of lower lows. Last week's candle closed below the prior week's low, and this week we pressed into 1-month lows. No bullish signal exists on the weekly timeframe. Drop to the daily chart. Here the picture is even sharper. The 200-day moving average is currently around 1.1920 and declining. Price has been below it for 18 consecutive sessions. That is institutional conviction. The 60-day moving average is at 1.1780, acting as a dynamic resistance that capped every rally attempt over the last 2 weeks. The 20-day moving average is at 1.1710 and it's accelerating lower. So we have the proper bearish alignment, 20 below 60, 60 below 200, all pointing down, and price firmly below all 3. That's a textbook trend continuation setup. The daily MACD is deep in negative territory, but here's the critical nuance. The histogram is still making lower lows, meaning momentum has not diverged yet. There is no hidden bullish divergence. Sellers are not exhausted. They are pacing themselves. Any bounce you see is a reloading opportunity, not a reversal. Now we go to the 4-hour chart, the trader's battlefield. The 200-period moving average on the 4H is at 1.1695. The 60-period is at 1.1655. The 20-period is at 1.1631. Notice something? The resistance cluster you were given, 1.1631 and 1.1636, aligns almost perfectly with the 20-period moving average and a minor swing low from yesterday. That's not random. That's where the short-term trend mean reversion will meet the first wave of sellers. On the 4H MACD, we have a bearish zero-line rejection. The MACD line tried to curl up towards the signal line, but it is rolling over before crossing into positive territory. That is a momentum failure. The bears are reloading. Also, we have a negative hidden divergence. Price made a lower low near 1.1600, but the MACD histogram printed a slightly higher low on the last leg. That pattern signals continuation, not reversal. Many traders misread that as bullish. It's not. It's telling you the selling pressure has more room to run. Zoom into the 60-minute chart for execution. The 200-period moving average on the hourly is at 1.1661 and dropping fast. The 60-period is at 1.1640, just above current price but acting as a dynamic ceiling. The 20-period is curled sideways, reflecting the temporary consolidation. But look at the MACD on the hourly. It's crossed bearish again after a brief pop above the zero line. This is a classic trap pattern. Price popped above the 20-period average, sucked in breakout buyers, and then slammed back below. The longs are now trapped, and their stop losses sit just below 1.1600. That liquidity pool is the target. Let me be crystal clear on the support and resistance levels that matter today. Key support 1.1608 is the immediate intraday floor, tested twice in the last 12 hours. Below that, we have 1.1594, the swing low from the Asian session, and then the psychological 1.1600 handle which sits right in between. If 1.1594 breaks with volume, the next downside magnet is 1.1550, the 2024 low pivot. Key resistance 1.1631 is the first hurdle, the 20-period average on 4H and yesterday's consolidation top. Above that, 1.1636 is the real invalidation point, a structural lower high that if taken out, would signal a short-term base. I will keep hammering this. A 60-minute close above 1.1636 shifts the bias to neutral, and we would then look for a push to 1.1695. But until then, we fade, now weave in the crosser-set linkage because the euro doesn't move in a vacuum. Look at the dollar index. It's grinding higher, holding above 105.50, and building a bull flag on the daily. The S&P 500 is choppy, risk appetite is fragile, and that supports the dollar as a haven. Meanwhile, pound sterling to US dollar is also under pressure, but the pound is holding up better. Why? Because the Bank of England is still expected to keep rates higher for longer than the ECB. The policy differential between the ECB and the BO is widening again. Eurozone inflation is falling faster, and ECB officials are opening the door to a rate cut as early as the next meeting. The bund yields are dropping relative to gilts and treasuries, and that yield disadvantage is crushing the euro. This is the dollar killer dynamic. When the ECB turns more dovish than the Fed, euro to US dollar is the cleanest short. And right now, that spread is only accelerating. Here's the fundamental driver for the next 24 hours. The news you need to know. Euro to US dollar found a footing at 1-month lows near 1.1600 overnight, but that footing is fragile. The bounce was driven by a minor short squeeze after a Reuters report that ECB members are split on the pace of cuts, but no hard commitment. Then a US session where a Fed hawk reminded markets that rates could stay restrictive for longer. That revived the dollar bid and sent euro back towards the lows. So this bounce is built on a narrative that will likely crack. We have Eurozone PMI data due tomorrow, which is expected to show manufacturing still in contraction. If it prints below expectations, 1.1600 won't hold. Also, the ECB minutes release is just around the corner, and any hint of urgency to cut will be the nail in the coffin. So my 1 to 2 week directional lean remains strongly bearish. The event that would invalidate that thesis is a daily close above 1.1710, the 20-day moving average. If that happens, I would abandon the short bias. But that's a 100 pip leap from here, unlikely without a major fundamental shift. Now we get to the part most people will skip, but this is where money is made. Keep watching. I'm giving you 3 precise trade setups for today, Wednesday, calibrated to the current price at 1.1644. Every setup includes the exact trigger, stop loss, targets, risk-reward, and invalidation condition. Use what fits your style. Strategy 1, the sniper, conservative. This is for traders who want a high probability entry with a strong confirmation signal. The trigger, wait for price to rally into the 1.1630 to 1.1636 resistance zone. We need to see a bearish rejection on the 15-minute chart, a shooting star, a bearish engulfing candle, or a long upper wick closing back below 1.1631. Once that forms, enter short at 1.1625. Stop loss goes at 1.1655, above the 60-period 4H moving average and the day's high, giving a 30 pip buffer. Target 1 is 1.1605. just above the key support zone, giving a 20 pip profit. Target 2 is 1.1565, extending to the next structural level, for a 60 pip gain. The risk is 30 pips, so target 1 gives a 0.67 reward to risk, but target 2 gives a full 2:1 reward to risk. If the entry trigger does not appear, meaning price just grinds sideways and never tests that resistance, you do nothing. This setup is voided if a 60-minute candle closes above 1.1640 without rejecting, because then the trap might be failing. Patience is the edge here. Strategy 2, the active trader, standard. This is for those who want to participate in the momentum breakdown without waiting for a pullback. The entry condition, a 15-minute close below 1.1608 with volume confirmation. That is the immediate support breaking. You can enter short on that close at 1.1605. Stop loss is placed at 1.1632, above the consolidation range and the 20-period 4H average. Risking 27 pips. Target 1 is 1.1590, just above the Asian low, a quick 15 pip scalp. Target 2 is 1.1550, the major pivot, for a 55 pip run. Once target 1 is hit, move the stop loss to break even. This setup exploits the stop loss cascade from trap longs below 1.1600. The risk-reward structure here, initial risk 27 pips, target 2 offers 55 pips, roughly 2:1. The setup is invalidated if we see a sudden spike through 1.1636 before the breakdown, because that signals a failure of the bearish structure. Right now, the 5-hour momentum is strong sell, so this aligns with the trend. Let's see how aligned we are. Type your euro to US dollar range for tomorrow in the comments now. I'm reading them. Tell me your high and low estimate. This interaction helps me gauge the sentiment, and I'll call out the best ones in tomorrow's video. Strategy 3, the aggressor, high risk. This is counter trend, only for those who know how to lose small and manage risk aggressively. The concept, a quick long scalp on a false break of 1.1600. If price spikes below 1.1600, say to 1.1595, but then instantly recovers with a bullish engulfing 5-minute candle closing back above 1.1608, you can enter long at 1.1610. Stop loss is tight at 1.1590, risking 20 pips. The target is a fast 30 to 40 pip pop to the 1.1640 resistance area. This is a 1-to-1 and a half-to-1 play, but it relies on a liquidity grab. If the spike down doesn't reverse within 2 candles, you exit immediately. This setup fails if price continues to drop and holds below 1.1600 for more than 5 minutes. It's a knife catch. If you are not experienced, stick with the first 2 strategies. Do not attempt this with size risk management pulse. Never risk more than 1 to 2% of your account on any single trade. No positions through high-impact news like Eurozone PMI or US ISM. Stops are non-negotiable. This is survival. Let's close this out and look ahead. The single most critical level for the next session remains 1.1600. A daily close below that opens the trapdoor to 1.1550 and potentially much lower over the coming weeks. The level that would start to flip the script is 1.1636 on a closing basis. As long as we stay below that, the fade is the play. Tomorrow, we have French and German PMI data, and the ECB minutes, so the volatility will be extreme. I'll be breaking that down right here. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live now. Check the end screen and keep the binge going. These cross-asset relationships are how institutions connect the dots, and missing one leaves you blind. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage of all 8 key assets. I'll see you in the next one, before the next move.